So this is a review session of the material we've covered so far this year. All right, jump into synergies here. We're going to kick off this review session with the 4C synergies framework. The two dimensions that define the synergies are similar resources versus dissimilar resources, and high resource modification versus low resource modification. It may actually be easier to think of kind of these keywords or most common examples of each of these. In particular, with consolidation synergies, the keyword to remember is smaller. So that might be producing goods with fewer factories or performing some task in the value chain with fewer people. So maybe it's fewer people in HR, fewer people in IT or purchasing. Again, the keyword there is smaller. Combination synergies might look very similar because they're similar resources as with consolidation, but the key issue there is increasing bargaining power or market power. That can be upstream or downstream. The same act might lead to both of these depending on how it's used. So if you see a question that mentions two purchasing teams being merged into a single purchasing team, if there's no other information, that does not tell you that any synergies are being created. If the question says that there are fewer people performing that task than otherwise there would be, that's consolidation synergy. If they're being combined to increase their market power over suppliers, that would be the combination synergy. It could be all of those, it could be none of those, it could be one or the other. Again, it depends on how the move is being used to create value. I think a lot of times there's confusion on this one because the popular press will often describe industry consolidation, which increases the market power of those firms that are being combined. So that is a common mistake, confusing those two. But again, combination is about market power, consolidation is about smaller. On the dissimilar resources side, we have the customization synergies. That's with the high modification. That is modifying things to be co-specialized or work better together. That could be horizontal. Maybe you're modifying complementary products to work better together. It could be vertical. Maybe you're modifying your supply chain to increase the value creation so that the inputs from one process work better with the outputs of another. Examples of that could actually be modifying the inputs or outputs themselves. Excuse me. But it could also just be locating them to be nearer to each other to lower transportation costs and things like that. With the connection synergy, we're talking about pooling resources. The most common examples of those are sharing a brand across different product lines or doing things like cross-selling, where different sales teams are able to sell for other product lines. So if we're talking about either of those, that is the connection resource synergy or pooling. In addition to thinking about resource modification, this table may also be useful during the exam to think about whether or not the synergies being created are one-sided or two-sided. The reason these two rows are particularly important is they determine the relative costs of transaction costs versus ownership costs, and whichever of those is lower will define whether synergies are best managed within a single firm or between firms. So if you have high resource modification and one-sided synergies, that tends to mean that the synergy is best managed within a single firm. If you have low modification and two-sided synergies, that tends to mean that the synergy is most efficiently managed between firms. You could have high modification with two-sided synergies, but I would not put that on the exam. For the exam purposes, you'll only be seeing things where they're either correlated or you only have information about one or the other. But again, high modification and one-sided synergies tend to be best managed within a firm, because transaction costs are higher than ownership costs in those cases. With these one-sided synergies, you also tend to see them in these off-diagonal quadrants with either givers or altruists or takers and parasites. With either of these quadrants, you have either benefits to the portfolio at the cost to the business unit, or benefits to the business unit at the cost to the rest of the portfolio. Actually, that's the opposite ones that I just highlighted there. The threshold of acceptance can also be higher or lower. The key factor that determines that is the cost of commission errors versus omission errors. If the cost of commission errors are high, that tends to be true with acquisitions, for example. There's a large downside risk of doing something, and that shifts the threshold up. So if you're thinking about acquiring a business and the synergies would be positive, you would expect more value to be created than the cost, but the risks are very high, then you may still not want to take that action. At the other extreme, you may have some slightly negative expected synergy value, but if the cost of errors of omission are high, that shifts the threshold down. So you might still want to create that synergy, even if the expected value is negative. And that would be common with new technologies or business models that might disrupt an industry. The next concept I wanted to cover in this section is on resource fungibility versus scale-free resources. The key issue to keep in mind here is that fungibility has nothing to do with opportunity cost. Opportunity cost is defined by whether or not the resource is scale-free or not. A common example of this question that we're seeing right now is with companies that are changing their production processes to make things like ventilators or personal protective equipment in response to this virus outbreak. If they're able to start producing some new products in response to this outbreak, that is an indicator that the resources are fungible. It means that they're broadly useful and can be used for some other purpose other than what they were originally intended for. So for example, you see General Motors with a lot of capabilities in manufacturing and production of complex devices being used to make ventilators. So there's some resource fungibility there. You also have the question of opportunity cost, and the opportunity cost is going to also vary from firm to firm, even if they're in very similar businesses. Right now, General Motors has a lot of excess capacity, so the opportunity cost of making ventilators is really low. They would probably be cutting production of cars anyway, so it's not really costing them a lot to make that transition. If you think of a company like Tesla, which has a big backlog of orders right now, the opportunity cost is much higher. So if they stop making cars to make ventilators, they're incurring a much larger cost. Arguably, that's why executives like Elon Musk have been purchasing ventilators to donate as opposed to reconfiguring their assembly line to make something else other than cars. So right now with COVID-19, you're seeing a lot of resource fungibility being used. And in some cases, the decision about whether or not to do that depends on the opportunity cost. In terms of categorizing these, again, you can think of fungibility as widely useful. Low fungibility is more idiosyncratic. If it's scale-free, there's no opportunity cost. If it's non-scale free, there is an opportunity cost and the resource must be allocated. The next topic here is intra versus intertemporal economies of scope. With the intertemporal, we're really talking about things like flexibility. With the intratemporal, with the within time economies, that is all of the 4C synergies that we've talked about before. So with 4C synergies, the cost of doing 2 activities or of having 2 business units is lower than the cost of having them not operate together. With intertemporal economies, it's saying that the cost of reallocating resources over time is lower than the cost of recreating those resources in a new company. Definitionally, when there are intertemporal economies of scope, when that definition of that intertemporal economies is true, then it implies an advantage over diversifying entrants, over de novo entrants or entrepreneurs. So when you see a new industry and a lot of big companies from other industries are doing well in that, that implies this intertemporal economies of scope. To take an example of that, that's been very widely studied in the strategy literature. With digital cameras, you have a lot of different companies that tried to enter into making digital cameras, but it was a lot of the existing camera companies like Nikon and Canon that did really well with that. Even with other companies, they often had lens technology for other purposes. So like Sony had been developing lenses for a long time for things like CD players and DVD players. So those allowed them to reallocate resources into digital photography and allowed them to have success in that industry over new entrants. As with all of these reallocations of resources, there are disruption or adjustment costs. In terms of minimizing adjustment costs, one factor that minimizes this is related diversification. Essentially, the more related the resource needs are of two businesses, the easier it is to allocate resources between them. So this relatedness increases fungibility intra and intertemporally. A key point to highlight here is that this fungibility is a nature of the resource, and that is separate from whether or not a synergy is actually being created. So you might have two business units that could be creating a 4C synergy based on sharing a resource between them. And that fungibility exists whether or not they're actually creating that synergy. So if there's a question about the fungibility of the resource, that could exist even if they're not creating the synergy. If it's a question about the synergy and the value being created, then it's a question about whether or not they're actually creating that. The other issue that affects flexibility and redeploying resources is modularity. Modularity means that there is high interdependence within modules and low interdependence between modules. Having high modularity increases flexibility, makes it easier to make changes within modules without affecting other aspects of the business. It also increases flexibility for divestiture, which we'll be talking about later. Modularity increases intertemporal economies of scope, but at the sacrifice or detriment of intratemporal economies. So you're getting less of the 4C synergies or less joint operation. So when we're thinking about all of these resources, again, there's different dimensions that are relevant to them. Resources could be more or less fungible, which is interchangeable or broadly useful. The resources can be more or less scale-free, which means if they're not scale-free, there's an opportunity cost and the resources have to be allocated. There's also the potential for trade-offs between intra and intertemporal economies. Diversification that's more related or with higher fungibility of resources between uses increases that fungibility intra and intertemporally. So there's no trade-off there with relatedness. In terms of modularity, that does create a trade-off between inter and intra-temporal economies. So the more flexibility you create through modularity, the fewer synergies that you'll be creating. So now we're thinking about demand synergies, just to contrast the resource synergies with demand synergies. Again, the resource synergies are about bringing together or sharing resources to lower costs or increase willingness to pay for your product or service. The synergy is realized through that joint operation of business units and often creates value completely independent of the customer's behavior. With demand synergies, on the other hand, It is about lowering costs or increased willingness to pay still, but it's often more specific to or contingent on customer behavior. So if it's based on one customer buying multiple things, that is a customer-specific synergy. You can also have synergies between customers of different types that may have different preferences for your value proposition. And that would be an indirect network effect, which can also create demand-side synergies. And pricing and bundling strategies can be important for both of these. Going a little bit more detail on these distinctions. Again, customers of one type may attract customers of a different type. This creates asymmetric utility or the indirect network effect. You may have the customer-specific synergies, which are higher willingness to pay or lower cost when one customer buys multiple offerings. A subcategory of that customer-specific synergy is simultaneous utility. Simultaneous utility exists when a customer is able to accomplish multiple tasks or multiple functions at the same time. So if you stop for gas and then pick up something from a convenience store, that's an example of simultaneous utility. If you're doing laundry and are able to do some tanning while your laundry is running, that's another example of simultaneous utility. You can also have customer-specific utility that comes from ecosystem interoperability. So if you are using two different software programs and they work well together, that might make you more willing to buy each of those. You could also just have interface familiarity. So maybe you don't use the software packages together, but the user interface is the same for each. So having learned one, it's easier to learn the other. That can be another example of this demand synergy. On the cost side, you could have a lower customer acquisition cost based on one of your products or services, creating knowledge about your customers or giving you access to those customers. You could also have lower costs from delivering more things at the same time to a single location. So I think an example I used of that was Amazon. And if you can ship two things in a single box, that's cheaper than sending those things in multiple boxes. So all of these are customer-specific synergies. I don't think I have it here, but that asymmetric utility often involves different preferences for simultaneous utility. So in that academic paper that looked at the context of laundry and tanning, some customers valued that combination and others did not value that combination because they were not interested in tanning. But they also had asymmetric utility for the presence of the other customer types. So these concepts can interact with each other and lead to more complex strategies. So these next couple of slides are about different ways of capturing value, particularly from these customer-specific synergies. So if you have a customer-specific cost synergy, you can use a peer product strategy to try to capture value from that. The way you would do that is lower prices across the board in the hopes that more of your customers would buy multiple offerings at the same time. So a lot of discount retailers online or in store have lower prices with the hope of attracting lots of customers to buy lots of things. That is not always the most efficient way to create value. The problem with lowering prices across the board is you're sharing some of the expected synergy value with customers that are still only buying one thing. For a willingness to pay synergy, this strategy works a little bit differently. With the willingness to pay synergy, the customer only gets value if they buy multiple things together. So they will self-select into doing that, and you can raise prices to capture some of that value from them. The other two bundling strategies, you have the mixed bundling strategy, which has a per product price and a lower bundle price. This is more efficient than the peer product strategy because you are not sharing any of that discount or sharing any of the expected synergy with customers that are still only buying one offering. So that makes it more cost effective for cost synergies. You would not use a mixed bundle for willingness to pay synergies because customers are already getting more value if they buy multiple things. So you do not need to give them a discount in order to change their behavior. With a pure bundling strategy, essentially you offer products only as a bundle. You might see that with a combination of hardware and software, for example, where many products like computers, tablets, or smartphones, you can't even buy them separately anymore from many vendors. You can also see a pure bundling strategy if you see an order minimum and orders below a certain amount are not accepted at all, which some businesses do as well. And when you have these pure bundling strategies, essentially the synergies are always realized, whether they're cost synergies or willingness to pay. And functionally, they're the same as shifting the supply curve or shifting the demand curve or both. So that brings us now to talking about the boundaries of the firm. This could involve vertical integration or horizontal diversification. With both of these, you are increasing the boundaries of the firm to either include more business units or more of your value chain. With the question of firm boundaries within this course, we're really focused on corporate strategy, which means we're thinking about synergies and whether or not synergies are best managed within a firm or between firms. So we're comparing these two right side quadrants of this matrix. The central question then becomes whether or not those synergies are best managed within a firm or between firms, and governance cost is what determines which of those make more sense. The Purnam and Vinost way of thinking about this is thinking about governance costs, which could be either ownership costs or transaction costs. And if you have a high need for resource modification for the synergy you're creating, or if the synergy you're creating is one-sided in nature, that increased transaction costs relative to ownership costs. And the gap between these two is what you would see as corporate advantage. So if you have two business units in the same company creating a particular set of synergies, the cost savings by managing those synergies within the company as opposed to between companies is the size of your corporate advantage. The next part that we talked about in this course was transaction cost economics. And this is another way of thinking about whether or not value is best created within a firm or between firms. The central question or issue in transaction cost economics is the issue of holdup or opportunism. And that often comes up with questions of transaction-specific investments or idiosyncratic investments. And the question there is, if I've already sunk this cost into investing in something that's uniquely valuable to you and not valuable if I work with anybody else, what is going to stop you from renegotiating terms to take advantage of me? There are three factors that increase this risk of holdup. And with higher levels of holdup, it makes more sense to organize those synergies and investments within a firm. The first is frequency. So with high frequency of transactions, there's an increased likelihood that something might change over time, and I might depend on you and you can force me to renegotiate. With asset specificity or transaction-specific investments or idiosyncratic investments, the question is, how do parties working together motivate the other to invest in resources that are uniquely valuable to them? With higher asset specificity, you have higher risk of holdup or opportunism. Finally, with uncertainty, with more uncertainty, it becomes more risky to invest in these idiosyncratic investments or highly relation-specific investments. So that also increases the risk of holdup. So the way that this is represented visually, as idiosyncratic investment increases and as the frequency of transactions increases, that pushes you towards organizing those investments within the firm as opposed to between firms. So as these increase, you shift from market transactions to alliances, joint ventures, and internal organization. As traditionally presented by transaction cost economists, uncertainty works in the same way, again, pushing you towards more increased control with internal organization. I would argue that uncertainty can also be managed through increased standardization. So if you think of this idiosyncratic investment, that would be high resource modification. You can think of the customization synergy as an example of that. If you could create customization synergies, but there's a lot of uncertainty and those investments might not pay off over the long term, rather than increasing control through internalization, you can instead just rely more on non-specific inputs. So you're not going to create that customization synergy, but you have much more flexibility if your needs change in the future because you can just go back to the market for different non-specific resources. All right, next we're going to talk about going global. So you'll notice that we're shifting changes in firm boundaries towards the end. In some ways, going global should be thought of very similarly to other synergies in the sense that you can have either multiple business units. You can also have operations in multiple countries to create value. And just as you can have vertical integration, you can divide your value chain across countries to create value. So that's what we'll be talking about with global corporate strategy. We presented 3 frameworks for global corporate strategy. The first, the adding value framework, is thinking about why you would change your global corporate strategy in order to increase value. So you're thinking about how your corporate scope can be used to create value. The second framework that we talked about was the CAGE framework. So you get to the CAGE framework when you've decided that you do want to create value with international scope. The CAGE framework thinks about where you want to go first, so which countries you want to increase operations in. And then the final framework that we talked about, the AAA triangle, was thinking about generic strategies for executing that value creation. So starting with this first framework, the adding value framework, probably the most obvious lever for international scope to create value is by increasing the size of the market you're serving. This doesn't mean that expanding your sales internationally will always create value. Again, as we talk about the CAGE framework, we'll be talking about things that make it more difficult to sell your product in some countries compared to others. Maybe it's geographic distance and the high cost of shipping. Maybe the level at which economies of scale operate. It might just be that your product is better suited for some markets than others. So adding volume does not always create value, but it's one justification for increasing global corporate scope, and that does sometimes create value. The next 3 levers all fit within the domain of margin. Just as with competitive advantage, you can use global corporate scope to decrease costs or increase willingness to pay through differentiation. So either of those can be used to create value through corporate scope. Often that might come through arbitrage, for example. So you may locate some parts of your value chain in a country where costs are very low, but the quality is still enough that you're not lowering your willingness to pay as much. Alternatively, you might use it for differentiation. So maybe you'll produce a product in a higher cost country, but where producing there increases willingness to pay even more than you're increasing the cost. This third lever for increasing margin is about industry attractiveness, and specifically improving industry attractiveness. This is talking about two different things. Most often, this is talking about increasing industry concentration at the level of analysis where that increasing concentration will reduce competition. If you're increasing concentration in your industry at the global level, and that reduces pricing competition, if it's a global market for whatever product it is you're selling, say it's computers or software, which tend to be pretty global markets, then you can improve the industry attractiveness by increasing your global scope. Sometimes you will not have that effect. Advertising is an example of an industry that exists primarily at the national level, though of course there are companies that operate internationally. Because you're competing with other advertisers to serve customers in a particular market, what's relevant is the concentration at the individual market level. Expanding internationally will actually decrease the concentration in any market that you enter. This is kind of referring to one of those quiz questions that a number of people had questions on. So by entering different markets, you may be decreasing the concentration in each of those markets, which would actually make the industry less attractive. Again, it might still make sense for you based on these other levers, but that would not be improving the industry attractiveness. The other lever for improving industry attractiveness is multi-market competition. That's a more complicated kind of a game theoretic approach to thinking about competition. But essentially the logic there is if you're competing against the same competitors in multiple markets, sometimes that will reduce how intensively you compete against them. If you have a relative advantage in one market and they have a relative advantage in a different, the way you compete in one could allow them to retaliate in a different market, and increasing multi-market contact in that way can improve industry attractiveness. The last two here are about normalizing or optimizing risk and generating knowledge or other resources. The key issue to remember with normalizing risk is that it's not always about increasing risk, or it's not always about decreasing risk. To use the supply chain as an example of that, splitting up your value chain into multiple countries might increase risks of disruption, but it could still be worth it if you're lowering costs even more. So that would be an example of increasing risk, but still creating more value. Alternatively, you might do things that decrease risk. For example, if you manufacture in several different countries, that might reduce your risk of disruption. And that could make sense for some industries, but for others that might not be worth it. If you can manufacture at a very low cost in one country, that might be worth it, even if that's higher risk. So again, with this normalizing risk, it's not just about always moving in one direction or the other. It's thinking about what the optimal type of risk is for your industry. Finally, with generating knowledge, that can happen in a lot of ways. Some examples of that are making very small entries into a new market in order to understand how attractive that market is. So that would be an example of generating knowledge. You can also use the knowledge that you gain from different markets to improve your operations globally. So for example, if you learn about an adaptation of your product that's useful in one market, you can think about how that adaptation might be valuable across your entire organization. So that would be an example of using global scope to generate knowledge. And I think I actually just went through each of these. But if you have questions later, you can also refer back to these slides that go into a lot more detail on each of those examples. One thing I'll add, this is a question that came up a few times in office hours. With the adding value scorecard, you're often focusing on the one or two aspects of the scorecard where you're planning to create value. So for example, if you're primarily focused on adding volume, you may not need to spend much time thinking about generating knowledge. The only exception where you would need to consider both simultaneously would be decreasing costs or differentiating. So doing something to decrease costs often also lowers willingness to pay, or doing something to differentiate often also increase costs. So the question there, you need to take into account both sides and ensure that you're creating more value and not just shifting one of those and not thinking about the effect on the other. But in general, when you're applying this framework, you can focus on the dimensions that are most relevant to your business. That brings us to the CAGE framework. The CAGE framework is thinking about distance along 4 dimensions: cultural distance, administrative distance, geographic distance, and economic distance. Again, the purpose of this framework is to think about where you will go first, especially. So if you're expanding your global corporate scope, what countries do you want to move to first? This is particularly relevant for the adaptation and aggregation strategies. So the closer you are on these dimensions, the less adaptation is required and the more benefits of aggregation you can get without needing to adapt your offering. Similarly, if you do need to adapt, the cost of adaptations would be lower the more similar the market is that you're adapting to. If you're thinking about arbitrage, you're often taking advantage of differences on these dimensions. So you may actually be looking for countries that are more distant in order to create value through arbitrage. With the CAGE framework, there are 2 types of analysis that are always required together. The first is the sensitivity analysis, thinking about your specific industry and which of these dimensions is most important. If geographic distance is most important, then you'll want to expand first into markets that are physically close to you. If cultural distance is more important, then maybe geographic distance doesn't matter, but you want to focus on countries that are more similar culturally. So an example of that is Netflix, which shows a lot of shows that were produced in Australia and the UK here. And similarly, I think they show a lot of US shows in those markets. So that's an example where cultural distance is really important, and it's pretty easy to ship that product overseas. It's just digital content that you move around on the internet, but the cultural distance is really important. So they entered first markets where they could use a lot of their existing content. So once you've figured out which dimensions are most important for your industry, then you want to figure out which countries are close on those distance dimensions. I'm not going to go through all of these. They're right here on the table. But a key distinction to remember when you're calculating distance, most often the most important issue will be bilateral distance. So if you're a company based in the US, you're thinking about which countries are close to you on each of these dimensions. There is also the issue of unilateral or multilateral distance, which might make any country hard to enter for anybody. So if there's a particularly difficult country to enter, say North Korea, there's not a lot of international business in North Korea. That's a unilateral distance measure that would make it difficult for anybody to enter. But generally speaking, when we're talking about distance, it's these bilateral measures. That brings us to the AAA framework. We're thinking here about the globalization of markets and production. Here we have the adaptation aggregation trade-off. And specifically, these are generic strategies for global corporate strategy. You can think of adaptation primarily as increasing willingness to pay. So modifying not just your product, but also maybe policies or pricing or competitive positioning in order to make your offering more appropriate for a particular market. There is cost of doing that. On the other side, you have aggregation or achieving economies of scale. So that is generally maximized by not adapting your offerings, and maximizing economies of scale tends to be more about lowering costs as opposed to increasing willingness to pay. This third dimension, arbitrage, is about absolute economies, which could be about increasing willingness to pay through something like cultural arbitrage, or it may be about lowering costs through economic arbitrage or administrative arbitrage. There you're thinking about taking advantage of differences between countries. Let's see here. So arbitrage tends to almost exclusively apply to vertical integrations, which will hopefully be more clear on the next couple of slides when I show some visual representations of these strategies. In terms of where to locate, again, for adaptation and aggregation, you're looking generally for countries that are more similar to your country. For arbitrage, you're trying to take advantage of differences between countries. Things to watch out for with adaptation would be excessive variety or complexity. So again, there's a cost of adapting your products and services. And if that does not increase willingness to pay more than you're increasing the cost, that adaptation is not adding value. At the other extreme with aggregation, you can risk excessive standardization or emphasis on scale. Sometimes you can make small changes and still get a lot of economies of scale, but have a pretty good impact on willingness to pay. Grolsch is a company that it seemed like from our case discussion was maybe overemphasizing economies of scale, producing everywhere for the entire world and mostly from their home country, and making minimal modifications, if any, to their product to sell around the world. So they were going for excessive standardization there, probably not creating a lot of value through that. With arbitrage, the risk, just as with financial arbitrage, is that the spread or advantage can be competed away. For example, if you are manufacturing in a low-cost country and that creates an advantage for you, your competitors may copy you and produce in the same low-cost country. And then at that point, that advantage is essentially competed away. So when you're thinking about the sustainability of your advantage, you need to keep in mind that this arbitrage can be competed away. An example of that happening on the willingness to pay side, there are a lot of luxury goods that are produced in Italy, for example, with a lot of leather goods. And there's been increasing competition for supply from that country, to the point that some luxury goods companies have actually started vertically integrating because they realized that just buying from suppliers there was no longer creating an advantage, that they actually had to own the supply there in order to prevent that arbitrage advantage from being competed away. So this is representing these strategies visually. These are different multinational corporate structures. Essentially what you're looking at for adaptation versus aggregation is following or looking from left to right at which parts of the value chain are being replicated across countries and which parts of the value chain are located in a single country. For all of these, this top function 1, is not replicated anywhere. In some cases, it's more or less split up, but again, none of it is replicated. If you compare the organizations on the left, you have more of the value chain with all of function 2 being replicated across geographies. On the right, you have less adaptation with only half of function 2 being replicated across geographies. So again, with adaptation here, it's about replicating parts of your value chain across countries in order to increase willingness to pay. Aggregation is the flip side of that. Aggregation is about not replicating functions. It's about concentrating a function in a particular geography in order to maximize economies of scale. So this is why you have that aggregation adaptation trade-off, where if you're replicating, by definition, you're not getting aggregation. If you're aggregating, almost by definition, you're not getting the adaptation. The third dimension here, or the third A strategy, is arbitrage. With arbitrage, you pretty much essentially have to start with some aggregation. And then the question is, how much are you slicing up this value chain across geographies? So are you aggregating two parts in just 2 different countries? Are you splitting it across a bunch of different countries? So these are differences in the amount of arbitrage, but in both cases, you have an equal amount of aggregation. You're just splitting up the aggregation across different countries. Shifting our focus now to adaptation strategies. I'm not going to go into all of these, but I just want to highlight the different categories of thinking about adaptation. First, you can have different dimensions of variation. So it's very easy to think about varying your product from country to country, but you can also vary a lot of other things in order to better compete. You can use focus to reduce the need for variation. So you may focus on products that need less adaptation from country to country. You can also focus on similar geographies so that there's less need for variation. Externalization is about shifting the burden of variation to somebody that can better manage it. So if you are trying to sell into many different countries and your product needs to be adapted for each of those countries, it may be difficult for you to figure out what those adaptations need to be, but you may be able to rely on local partners to figure that out for you. So that would be externalizing that burden of variation. You can design your products to reduce the cost of variation, essentially separating out those parts that can be the same everywhere from those parts that need to be adapted from market to market. So for example, with computers, the standalone part of the computer tends to be the same everywhere. And then the power plug or power adapter can be adapted from market to market. So that would be an example of modularity or creating a platform. With improving the effectiveness of variation, there are 4 strategies here. Transfer is taking adaptations from one place and applying them to somewhere else that's similar. So if you're a US company and you've adapted your product for Costa Rica, rather than starting from scratch to adapt your product for Nicaragua, you can take the adaptations you used in Costa Rica and bring them to Nicaragua. So that's an example of transfer. Localization is essentially allowing innovation within the target geography. So allowing your employees in each country to figure out what needs to be adapted. Recombination is a more extreme version of that, essentially allowing products to be created from scratch for local markets. And then transformation is rather than adapting your product or service for different markets, trying to modify local tastes to appreciate what you're selling. So if you're selling Starbucks or Harley Davidsons around the world, rather than modifying that product for different markets, you try to convince them that they should appreciate what it is that you're already selling. In terms of arbitrage in the cage, again, you're taking advantage of differences across these dimensions. I'm not going to go through all of these, but you might take advantage of administrative differences or economic differences to produce at a lower cost. You might rely on something like cultural arbitrage to produce somewhere where the willingness to pay will be higher for your product. Anyway, you're taking advantage of those differences. Arbitrage can be also applied across the adding value scorecard. So you can think about how locating different parts of your value chain in different countries can accomplish these different goals. So either increasing volume, decreasing costs, differentiating. I'm not going to go through all of these. Again, these slides are available on the assignment for today, so you can just download them there if you want. For the final exam, you may want to download that PDF, and you can use Control F to find any keywords if you need to refresh your memory on anything. So finally, we're going to talk about changing scope. So thinking about the different pathways for development, whether it's internal development, alliances, acquisitions, and also divestiture. Um, these modes can be applied for any of the previous strategies we've talked about. So you can use M&A or internal development for changing your global corporate scope. Similarly, you can use them for changing the number of businesses that you're operating in or how vertically integrated you are. There are two different perspectives for thinking about this. One is the Purnam and Vinas perspective. This is from the book titled Corporate Strategy that a lot of the frameworks from this course come from. Their perspective is that you start by identifying the synergies you want to create, and then based on those synergies, the governance costs of transacting through the market might be higher or lower than transacting within a firm with ownership costs. So essentially, you start with those synergies and then decide on internal or external organization. If it's external organization, that pushes you to alliances of some sort. If it's internal, then the question becomes whether or not to use internal development or M&A to acquire the resources you want. And then there's the key trade-offs framework for thinking about that. So again, the key issue here with this perspective is thinking about internal versus external first. And then if it's internal, thinking about the best way of internalizing the synergies. With the Caprone and Mitchell perspective, this is the resource pathways framework. Instead, you start with a specific resource gap, which comes from the synergy or synergies you're trying to create. You have some strategy. You identify the resources that you need for this strategy that you don't already have. And then you go through the resource pathways framework to think about the best way of acquiring those synergies. So again, with this framework, the very, very critical first step is identifying your strategic resource gap. The way this is organized is you have questions for each pathway with an overarching question that's decomposed into two separate knowledge questions and governance questions. So with internal resource development, the question is the relevance of your existing resources, and that includes your knowledge fit and your organizational fit. And again, you move through each of these, and if you reject it, you're moving forward and considering the next step, and you do this one step at a time. So if you decide that contracting makes the most sense, you would not continue to consider alliances and acquisitions. You would stop at the contracting phase. So you move through each of these, and then if you get to the end and none of these pathways make sense, if you've rejected all of them, then you need to redefine your strategy. I'm not going to go through each of these in a lot of detail, but on the last step, I just want to highlight that a clear integration map essentially requires an identification of the synergies you're hoping to create. And also, you need to think about the resources that you're acquiring that were not originally part of that resource gap that you were hoping to fill. And you need to know what you're going to do with those resources. So that could include a plan for divestiture as part of your integration map. If you don't have a clear integration map, it's usually because you either haven't identified your strategic resource gap, or if you have identified that, you still don't have a clear map. It's because you haven't thought about all of the unnecessary resources and what to do with those. All right, that brings us back to the Purnam and Vinas perspective. Again, if you're at this point, the point of this framework, you've already decided that the best way to organize the synergies are within the firm as opposed to between firms. And then the question is between acquisition or internal development. Here, a factor that would favor acquisition would be external resource availability. That doesn't just mean that the resource exists externally. It also has to be available to you. So if it's owned by a competitor that you would not be able to acquire, or if the resources are owned by a much, much larger company that would be too big for you to acquire, then it's not really available to you. Alternatively, if you want internal development, you either need both easy to copy and easy to catch up, or easy to substitute. Both of those are options. Let me go to the next slide here to talk about those. For easy to copy, there are things that can prevent you from copying a resource. There could be literally legal barriers, such as intellectual property laws, but there could also be tacit knowledge or causal ambiguity that make it difficult for you to know how to develop that resource that you're hoping for. So either of those can make it difficult to copy. If it is easy to copy, you also need to ask whether or not you're capable of catching up to what the level you need is. There are things that can act as barriers to catching up. You may not have the necessary resources needed to develop some new resource. Also, there might be positive feedback loops. So if you have compounding growth in a particular resource, being far behind the competition in that resource can make it difficult to catch up. Similarly, time compression diseconomies can make it difficult to catch up. Some things like trust or reputation or brand recognition are more easily developed over a longer period of time. So that can also make it difficult to catch up. So again, you want, if you need to acquire these resources and you're thinking about developing them internally, you would need both easy to copy and easy to catch up. Alternatively, you can have easy to substitute. So there may be other resources that you already have or that would be easy for you to develop that could substitute and allow you to create the same value at a lower cost. So this is also an option if copying and catching up is not an option. This next slide here, we had a paper on complementarity of modes. So this is thinking about complementarity between internal development, alliances, and acquisitions. The argument here is that there can be complementarity primarily between internal development and either alliances or acquisitions. And this is particularly relevant in industries that are very knowledge intensive, where you often need to be doing your own internal development in order to better understand external developments in the market. And you often need to bring in external developments in order to continue your own internal development. So that's what that's talking about. In addition to complementarity between modes, this next paper talks about exploration versus exploitation, which these authors argue should be balanced across modes. So exploration is about finding new technologies, new opportunities. Exploitation is about maximizing the value from those previously identified opportunities. You need a balance of these to do well. The authors of this argue that you tend to get better and better at one or the other within each mode. So if you do a lot of exploitation using internal development, you will get better and better at exploiting current opportunities with that internal development, but you'll be less capable of exploring with that same mode. So these authors argue that you should have some balance across modes. So perhaps using internal development for exploitation and acquisitions for exploration. That was the argument of this paper. So those last two slides talked about complementarity and balance between and across modes. This next slide is thinking about relational advantage. So this would be specific to alliances or partnerships. These are characteristics of or determinants of relational advantage. Essentially, the stronger a relationship is, the easier it is to have relation-specific assets, so developing assets that are uniquely valuable within the relationship. You can share knowledge more effectively with a strong relationship. You can develop complementary resources. In terms of effective governance, this is thinking about holdup and opportunism and how strong relationships can overcome those risks without incurring the costs of either internalization or litigation or things like that. So the critical thing there is about using things like norms of reciprocity, trust between partners in order to create value that would normally need to be done within a firm. But if with a good relationship, you can create that between firms. In terms of sustaining this relational advantage, many of these are very similar to factors from the resource-based view. So if you're using resources that are valuable, rare, inimitable, or non-substitutable, all of that can sustain this relational advantage. Also with relationships, you often have causal ambiguity and time compression diseconomies. So replicating a strong relationship between companies is difficult for outsiders to do. Similarly, you may have interorganizational, essentially complementarity between resources that increases dependence. A couple things that are unique to the relational view. One is partner scarcity. So there's only so many partners out there with certain resources. So if you're trying to identify that complementarity, identifying that first and creating that strong relationship first can be enough to sustain that advantage. Similarly, resource indivisibility can sustain this advantage. Next here, we have the knowledge-based view. This is very specific to joint venturing, and it's thinking about problems that joint venturing exists to solve. So the main issue that joint venturing is intended to solve is issues with tacit knowledge, where sharing the knowledge is necessary for the creation of value, but you also don't want to lose control or ownership over that shared knowledge. The joint venture is the creation of a new legal entity that has an ownership stake by both partners, and that allows the sharing of knowledge. So people can be put into this joint venture and they can work side by side with each other, working together to solve problems, sharing tacit knowledge. But because it's owned by both partners, you maintain ownership and some control over those resources. So that's the knowledge-based view and why joint venturing is considered to be uniquely valuable for solving this problem. Shifting now to acquisitions, there's a couple of specific ways to think about that. Here we're thinking about the optimal level of integration. The key issue here is decreasing marginal benefits from each incremental synergy. So you'll create the most valuable synergies first and get a lot of value from those. And then each additional synergy will probably create a little bit less value than the one before it. And with the more of these synergies you create, the more disruption you create between businesses that are integrating. And that creates an optimal level of integration. And that's what goes into your integration map in terms of thinking about that resource pathway. So you have an optimal level of integration. There can also be time compression diseconomies here. So creating the same number of synergies over 2 years as opposed to 1 year might limit the disruption by spreading out that integration over time. The second theory that we talked about in terms of integration was deliberate learning. Specifically, it's very difficult to learn how to acquire better over time because there's a lot of causal ambiguity in what makes an acquisition successful. These authors, Maurizio Zollo and Harbir Singh, argued that codification is valuable. Specifically, they believe that the process of retrospection, where you sit down and think about the decisions you made and the outcomes of those decisions, can be used to make firms more and more effective at integration and acquisition over time. They're ambiguous on whether or not it's the written materials that are valuable or that process of retrospection. But they also argue that these can complement each other, and firms can develop routines over time to essentially learn how to acquire better and better by repeating the same actions over and over. In terms of the distinctions between M&A and alliances, we've already covered a lot of those. You obviously have the internal versus external organization of synergies, and their different pathways. Another distinction is the distribution of gains. With an acquisition, you're negotiating that upfront, and the seller is getting their share of the expected synergies upfront, whereas alliances are much more flexible, and you can change over time, figuring out which synergies work, which ones do not, and how the value from those should be divided. With divestiture here, we're thinking about sell-offs versus spin-offs. If there's a better parent, that means they value the divested unit more than you value it, including any of the synergies you hope to create. If there is a better parent, you sell it off. If there's not a better parent and the synergy test fails, if you're not creating value through the combination, you should also spin it off, creating a separate legal entity for that business. If there's not a better parent and you do have synergies, you may keep that, but you may also spin it off. The central issue there is maximizing value, not just the synergies. So you're thinking about whether or not that synergy is best created within a firm or between firms. And if it's best created between firms, again, you can spin it off. Legacy divestitures are particularly risky. This is describing divestiture of the legacy core business unit or the oldest part of your business. Essentially, because businesses evolve over time, there's a lot of interdependent decisions, and the oldest business unit will be affecting more of those than any other business unit. That knowledge about interdependence is tacit, which makes it difficult for new executives or outside investors to fully appreciate. So this often leads to unwise and value-destroying divestitures. Even if from the outside it looks like there's not a lot of value there, maybe the legacy core is growing slowly or not as profitable as it once was, it's important to appreciate that interdependence that may not be easily visible from the outside. And finally, on divestitures, there's a strategic management view of divestitures. They're an expected part of creating value over time with acquiring resources, recombining them, reconfiguring them, and divesting resources that are no longer needed. To maximize this flexibility, you can rely on modularity. But as we discussed previously, modularity does come at a cost of sacrificing intra-temporal economies of scope. So increasing modularity makes it easier to divest, but you may be sacrificing some of those 4C synergies to do so.